how to analyze liquidity ratio. And remember friends, not only we are going to understand all these four categories of the ratios, but we are also going to use and these ratios and calculate these ratios for our company by using the financials of our company, which are already available with all of you. So the first to evaluate liquidity of a business, first ratio that we calculate is known as uh, current ratio. How do we calculate the current ratio? Current assets divided by the current liabilities. And you understand what is current asset? Assets which are expected to get converted into cash within a period of 1 year are current assets. And what are current liabilities? Liabilities which are required to be paid by a business within a period of next 12 months are known as current liabilities. So that is the ratio number one that we calculate, and that is known as current ratio. Besides current ratio, to evaluate liquidity of a business, we calculate another ratio, and that is known as quick ratio, or it is known as asset ratio. What is the difference between the current ratio and the quick ratio? The difference is of inventory. The difference is of inventory. So remember, current ratio tells us what? Current ratio tells us our ability to take care of our short term obligations. So let's say, for example, there's a company whose current assets are 100 and the current liabilities are 50. So what is the current ratio of this company? Current ratio of this company is 2. Meaning what? Meaning company has got the ability to pay its liabilities twice over. And that means from the liquidity point of view, it is a good sign. Then you have quick ratio. And how do we calculate quick ratio? You can see in case of a quick ratio, what we do, we take the current assets, but from the current asset, we minus the inventories. And why do we minus the inventories? We minus the inventories from the total of the current assets because inventories are not as liquid as my receivables or as my cash and bank balance. Why inventory is not liquid? Inventory is not liquid because if I have to sell my raw material to anyone, first of all, I will have to find a buyer. And if I am able to find a buyer, what the buyer is going to tell me? Buyer is going to tell me, I will purchase your raw material, but not at the price at which you have bought. I will purchase it at 20% discount, and I will pay you as and when I have the money. And therefore, inventory is not quickly realizable, and that is why we calculate this quick ratio. So quick ratio is an indicator as to which are the current assets which can quickly turn into cash. And this is how you calculate your quick ratio or the asset ratio, and that is current assets minus inventories. So let's say, for example, a business has got 100 as the current assets and it has got inventories of 80, and therefore the current ratio, the quick ratio will be 20 divided by 50, and that means it is going to be 4, only 4, right? So which is not a good sign. So quick ratio gives us a better idea of a business's liquidity than the current ratio. Any question?